Hi guys, I am Smart Evelyn. This is Heroine Chic, where we unlock your inner shero. That's heroin spelled with an E, by the way. I want to introduce you first to my co-host today.
Hi, I'm Jan.
Hi, I'm Cher Castillo.
And today our special guest is David Hill with David Hill Agency.
Hello.
And David makes insurance sexy. He's going to talk to us today.
Trying to.
He's actually going to talk to us today about financing your future and how insurance vehicles play into that.
Yeah, absolutely.
So tell us a little bit more about yourself, about what you do, about your agency.
So David Hill. I've been working in insurance now for 5 years. I work under a brokerage, Family First Life. My company is the Hill Agency. And I worked in sales for the last 20 plus years now. So I worked wireless sales prior to insurance, management for about 10 years of that, ran the training department for a couple companies, but always something sales related. So insurance kind of fell into my lap through somebody I was dating, and it's been an interesting ride. I've learned a lot, grown a lot, but it's definitely been an interesting ride. I think it's one of the most important things that probably doesn't get talked about a lot when it
Yeah.
comes to life insurance. I think there's a lot of bad stigmatisms around it, but I definitely enjoy what I do. It's been a roller coaster. Looking forward to doing it for a long time.
So that's what we really want to talk about today is life insurance vehicles and how this can actually finance your future in different ways. So the different vehicles that exist, can you just kind of break down the two most common life insurance vehicles?
So it's actually three. So
Okay.
really, when I have a conversation with any client, you're looking at either term insurance, whole
Mhm.
life, or universal, also known as index universal life insurance, right?
Okay.
So who it's best for and which one's best always depends on the person. So I think a lot of people have a lot of pre-notions of terms better or whole life is better or IUL's best. It really depends on the person. So I don't have any biasness where I'm like, you have to get this. This is the good thing.
Okay.
It's always depending on different people's situation. Everyone's in different income brackets. People have different goals. Some people want to use it as an investment vehicle. Some people just want to, have money to pay for a funeral, which I think is the majority of a lot of people that get life insurance. They just want to have burial costs covered.
Really?
A lot of
I thought there
people.
was a special policy just for that.
So you're talking about IULs,
Okay.
which I can go, more in depth in that, but I would say that 97% of the people I meet with are, well, so first of all, the clients that I primarily deal with are doing asset protection.
Okay.
So I know you guys all do real estate. So 5 minutes after you guys are done with those clients, I meet those clients. Anybody that's done a refinance, anybody that just
Yeah.
purchased a home, I basically help them get enough coverage to cover the mortgage on the house. So husbands, wives, who are in a income situation where they wouldn't be able to afford the property if the other person was gone, I make sure there's enough insurance that, husband's not around, you don't have that 100,000, whatever it is, the wife can keep the mortgage going. Or which typically happens is they have enough money to at least keep the payments going until they can sell the property.
So to clarify, he's not doing home insurance. He is talking about when you buy a home that you set up insurance that in case, let's say there's a loss of job or one of the spouses, if both of you are paying, you'll have money to still continue to pay for the house.
Absolutely. So yeah, so primarily what I deal with is I deal with final expense, which
Mhm.
is burial costs, cremation, funeral, that type of thing. Asset protection, which is we call it mortgage protection insurance. So
Hmm.
people looking to cover the mortgage, and I do annuities. So people that want to roll over Roth IRAs, TSPs for government, 401ks. I do annuities for those people and anything in between if people just have a lot of money in savings they want to put into an annuity somewhere
What's
safe.
an annuity?
So annuities are pretty much, they work very similar to 401ks. They're all interest accruing accounts, right? But with your 401k, you guys lose money. So if you have a 401k, most people who have a 401k with any job, Usually people don't know how to do their allocations, right? They have some type of automated system that may pick it for them, or they may just put any random numbers in, right?
Right.
So you might get like 14% interest on a 401k throughout the year, but at the same time, you probably lost 11% because of changes in the market, right? So with annuities, the way the carrier works is when the market bottoms out or has issues, they hedge all the risk. Let's say it's just an all around bad year, like 2008 when real estate market crashed, right? They will have you just collect 0% interest for the year rather than losing money, right? So as people typically get older, and if you've had a 401k for a long time, so I work with a lot of government, military, stuff like that. They might have had their 401k for 10, 20 years, and they might have upwards of 200,000 or more in there, right? But they've been washing the money every year because it might go up 20,000 and they might lose 20,000, 18,000 in the same year because of all the changes in the market. COVID was a really good reflection of that the last 2 years. The market was all over the place, and especially this past year with real estate, people are not really making money like that with their 401k if they were really watching it closely, aside from the few people who know how to do their allocations. So with the annuity, the carrier says, hey, on all those periods where you would have lost money, you'll just plateau. It'll be 0% interest. There's no loss. There's no gain, right? So even though you have higher gains with the 401, you might have, let's say your 401 does 14%, and annuity, you might see 7%, 8%, 9%, but you never have to worry about losing money. That's the difference. So people typically want safer investment vehicles as they get older. They don't want to keep being in a situation where they're losing money, because as you're nearing retirement, you can't afford to lose money when you're nearing retirement. Everybody has a dollar amount that they need to survive when they stop working. And as you get closer to that deadline, you need as much money as possible, right? So that's really what the annuities are good for. It's a safe vehicle. Never got to worry about losing your money. You can withdraw the money every year whenever you want, up to a certain limit, depending on how long you've bought the annuity for. So they're typically they're typically set up for 3, 5, or 7 years or longer, depending on the carrier you're with. And within that period, you can take out certain withdrawals. And if you don't need to take it out, great. If you want to leave a beneficiary for it, if you don't never plan on making withdrawals, you can.
Do you have to pay yourself back if you take it out?
So if you take it out, it depends on how much you take out. So typically, like the main carrier I use for mine, they allow 10% withdrawals every year. So
Without penalty, like 401k?
without penalty,
okay.
right? So 401k, you have a penalty up until, I think it's like 69 and a half now, right?
Yeah.
So instead of even the age restriction, which is a whole other thing with 401k, there is no age restriction, right? You buy an annuity now, let's say next year you need to take some of that money out. You don't go past 10% of the principal balance, you're totally fine. And what's really good, what they've been doing now for a couple years, is depending on how much money you put in, they will automatically put 10% interest in day one. So let's say you put 100,000 in today, it's automatically going to be at 110,000 within 24 hours. That's just what they give you off bat, just for the investment, right? And then after that, if you have to take out money, you don't go past that 10%, you see no penalties.
Yeah.
So we're talking about a couple of different types of insurance here. And I know you mentioned like coverage of a mortgage. So you said we're in real estate. This is true. There's a lot of intersection here. So, I have a title company. We sell title insurance. We insure your ownership of your property, right? You mentioned homeowners insurance, which is a different kind of insurance, which you're going to purchase when you buy your house. So if your roof flies off in a storm, if a tree falls in your yard, like one did in my yard a week ago, your homeowner's insurance covers stuff like that. And then the life insurance vehicles, there are 3 of them. Can we explain the way that each one actually works?
Absolutely.
Like kind of the benefits and downsides of each one.
Absolutely. So the simplest way to explain it is with term, right? Term is very black and white. You have coverage for a period of time. It could be 10, 15, 20, up to 30 years. Typically, if I do a term policy, I don't do any term that is not cash back. So that's something that's a little bit newer. A lot of people are not familiar with that. So basically, if you let's say do a 30-year term and you do cash back and you complete the term fully, they will give you 100% of your premium back. So it'll be like you had free insurance the whole time. A lot of people are not used to even hearing about that kind of term. The term that most people are used to is you get like $500,000 for like $50. It's super cheap, covers them for that period, and then it's just over, and the carrier collects the money. And there's a couple reasons why, and this is a personal biasness. I don't like that type of coverage because, for one, most of the time, the people who get approved for that type of coverage are healthy, so you're going to outlive it. And this is actually a very well-known thing within the industry. Most people who get term insurance, period, outlive the policies, which is why the carriers even actually pay extra commission to the agents for selling term because they're going to make money on it no matter what. Most people don't even finish their term policies.
Right.
So forget whether you outlive it or not. Most people will cancel it after a couple of years because they find something better, they can't afford it, whatever the case is. So it's just free money you've gave the carrier, right? So it's a waste of time. So at least with the term cash back, there's a little bit of living benefit incentive. You get all your money back if you do complete it. If you don't complete it, all's well
But
as
what
it
about
was.
conversion? So when I was going through a divorce, when I finished, I didn't have any kind of insurance. And like as you said, I'm in real estate, right? And I thought to myself, well, I better get some kind of insurance. And at first, all I could afford was term, right? So I got what I could afford, and it covers, obviously, like you said, if let's say I fell ill, it would still pay things, it would, help me. But eventually she came to me and she was like, okay, well, you can convert some or all. So at that point,
Convert to what though?
whole life.
Okay.
So I think I converted like half to whole life. Like,
So I have a question.
okay.
Who said why did you say that's all you could afford at the time? Who said that was all you can afford?
Well,
Like
she went through the costs of stuff, and with the costs that I had, and then what I made, you know, what she was saying the whole life was at the time, I couldn't afford that.
mhm.
So I was like, okay, well, at least I'll have coverage for something.
How long ago was this?
This was
Some
maybe,
years?
how?
Years?
Yeah, a couple years.
So this is what I typically find, right?
Right.
So traditional whole life is not something that's really sold to younger people. It's
Uh-huh.
something that's really offered 50 and up. So I don't think any of you guys have hit that age bracket. I'm only 37. The thing with term is pushed because, for one, they'll approve you for it from 18 and beyond,
Mhm.
right? If you're younger, you're probably healthy. It's going to be a fast approval. But you could have jumped straight to an IUL. So like when I meet with a lot of people, so let me explain the differences first, and this will make a little bit more sense. It'll connect. With regular whole life, it lasts your whole life. It accrues interest, right? It accrues interest typically between 2 and 4% on average. Sometimes it could be less than that if there's something apocalyptic happening in the market, but typically it's going to be between 2 and 4%. Just very average interest, right? But the IUL, it functions the same way. Most IULs now are structured in a way where they'll last you up to age 110. Even some companies I have go up to 120. So if you break some kind of record and live past Moses, it's still you're still going to have coverage, right? But the IULs accrue more interest than a traditional whole life. So they usually will accrue interest between 5 and I've seen as high as 14%,
And they
depending on,
cost like around the same?
and the cost about the same. So the catch is the age you get the insurance, right? It's really the age and your health situation. So when people talk to me about budget, and I just ran into this yesterday because I just did an IUL last night for a repeat client. This is his third policy he got. He's only 27. He's already gotten 2 term cashback policies from me. I met with this guy probably my first year doing insurance. So I've done a lot of IULs now for the past couple of years. I've been doing this for 5 years. I do a lot of IUL business because most of the people I meet with are between 20 and let's say 48, right under 50. And then I have quite a few seniors between 50 to 75, 80. I've met with people as old as 90 years old. The thing with the IULs is you have to be in almost athletic shape to get approved for them because the carrier is not taking on any risk to allow you to get that kind of product because of all the benefits that comes with the product, right? But the IUL is very depending on how it's structured, can be very low cost. So like an example is I did 2 IULs for shares kids. They're just level IULs. So they don't change. The death benefit is not increasing. So, let's say there were 100,000. That 100,000 is not going to increase until the policies have accumulated a certain amount of cash interest. People can structure IULs in a way where they're overfunded and the death benefit goes up while the premium stays the same. So like the death benefit could be 100,000, but then after a period of time, it could go up to 150, 200, and keep going the longer you've been paying on it. The point is that how much you pay is really relative to how much coverage you want it, right? So when you say like the budget thing, somebody could get a term policy for $50 and I could sell them an IUL also for $50. That's how much coverage you want. So, for me, when I meet with people, I take financial inventory. I want to know income for the household. I want to know what the goals are. Do you foresee? I've met with husbands who work in construction. There's periods of time they're on and off of work. So I don't want them to get a policy that during the times they may not be able, to work, they can't afford it and the policy is going to lapse, right? So when agents are having these conversations, they don't explain all the options in a way that makes sense to the client. And you guys only know what you know, right? Aside from Googling something online. So if somebody doesn't break it down in a way for you to really understand your options based off of your budget, then you will assume that term is your best option. But I haven't sold a term policy in over a year. I really don't even sell term policies like that. And now that it's become this whole big thing on social media where everybody's talking about IULs and how you can invest and use them to buy property and all this stuff, it's kind of like gotten popular. But IUL's been around for 100 years. These insurance companies are like 200 years old. It's not a new thing. Just people are kind of just starting to get, hip to the ways that they can utilize them for other stuff.
So David, let's talk a little bit about that because I was very unfamiliar with the different types of insurances before I purchased them 10 years ago. It was the first time I always had term. It was gifted to me. And then I started understanding the value of whole life and really becoming my own bank. Can you talk a little bit about how that works?
Yeah, so basically, when you see a lot of people speaking about becoming your bank, the whole deal is you can have money sitting in a savings account accruing like, I don't even know what it is now, like 0.5% interest or something, something ridiculous, right? You can take that same money, put it into an IUL and start accruing the interest I was talking about, that 4, 5, 6, 7, 10, 14%, right? That money can be taken out typically, I don't want to say at any point in time because it depends on how the client has funded the IUL. So if you're just making your regular monthly payments, like let's say it was a $100 a month policy and that's all you've been doing is just paying $100, there's not going to be any interest there for a while. There may be interest there after the first year, but typically it takes 5 years for a policy to really start accruing interest, right?
On
So
on a
IUL?
on a level IUL. So if you're just making your regular payments, you're not doing anything fancy. I don't care if it's, 100,000 policy or $1 million policy, right? The way people use as an investment vehicle is they say, hey, I got 20 grand in my savings account. I don't really need to touch it. Maybe they have other money in other places, they have investments, whatever, right? I'll take the 20 grand. I'll make a single pay premium payment on my policy. Depending on how much the policy was, that may pay up the policy. So, there's some policies where you pay them up to a point and the carrier says you can't pay us anymore because you've paid too much. There's IRS guidelines with that stuff, right? So they may say, okay, I'm gonna put the whole 20,000 in there. My policy is now paid up for the next, 15 years, whatever it is, right? It's going to immediately start accruing a large amount of interest because normally that policy was only accruing interest off that $100 a month, which is like $1,200 a year.
Right.
Now it's accruing 7%, 10%, whatever it is off that 20,000. And because you've overfunded it, where maybe it wasn't going to see that interest in the first year, it's seeing that interest immediately now, right?
Okay.
The next year, the person may say, okay, the policy has now gone from cash value of 20,000 to 32,000, something like that. I'm gonna take out 10 grand and go put it as a down payment on a property, right? So a lot of the very high income earners, that's what they're speaking to. They don't always go super in depth into it. And I don't think everyone's in that position, right? To just take $20,000, $30,000, dump it to an IUL and never be able to see it again because there are tax implications and stuff to that. I mean, you're still going to have to, there's other steps to that. It's not just like you put the money there and you can take the money out whenever you want, right? But if you're in a position where you have savings like that and it's money that is basically disposable, you don't need to touch it. That's a great option because
Rather than putting it in savings in a
and it's
bank.
just sitting there,
Yeah.
right? You're going to accrue the interest a lot faster. And when you have cash value interest on a life insurance policy, that money can be used anytime you want. If the money is there, the money can be used, period. And it's different from why I speak to a lot of young people about this. Let's say a more simpler situation, right? You just need a down payment for a car, or emergency happens around the house. You got to pay the mortgage for the next couple of months because somebody's out of work, right? You can call the carrier to borrow your own money today, and they're going to cut the check like that if the money is there. Versus that person normally has to go to a bank, have their credit ran, hopefully get approved for a loan, hopefully get the amount that they need for whatever's going on. You don't need to deal with any of that. You call the carrier, you say, hey, I see there's $10,000 in cash value interest there. I need to borrow $5,000. Okay, no problem, Mr. and Mrs. John Smith. We're going to send it out today. It literally does not matter what the reason is.
Right.
And then when you pay that money back to yourself, typically you're paying it back only at like, it could range from, let's say, 1.75% interest rate to 4% or something. It depends on what's going on at the time. The rate is going to be lower 100% than the rate you would pay to a bank. That's the big thing.
Yeah.
So I don't care how bad the market is going. The money you pay back to yourself is going to be far less than if you went to the bank for the loan.
And we typically don't think to do that. I mean, because I didn't think to do that before. I would get a line of credit on my house to do an investment project or what have you, or even purchasing a car. I would get it financed through the credit union or leasing it when I could have been just borrowing for my whole life
From yourself.
policy for pennies, but we're just not taught to think that way.
So I was
Exactly.
gonna say this topic was, it's even though you're very sexy, David, the topic is not necessarily right a very sexy topic,
Right.
except that I think it's so super important, especially for our community, to understand this because this has been understood by other communities for the longest, and they've been using this and building trust, doing all this stuff that we don't even begin to understand because obviously there was nobody to teach us that. You understand what I'm saying? So I just think it's so important. And like Cher said, she had these policies sitting there and didn't even know how to utilize them in a certain way and leverage them. And that's why I think this topic is so important.
Yeah, I'll tell you guys something interesting. This is a little bit more personal with me. So my uncle just passed away December 30th, New
Sorry.
Year's. Okay, appreciate that. That is my grandmother's son, right? So he had a policy from the 90s that he kept active the whole time.
Yeah.
Never missed a payment, okay, since like 1992. So that's like 30 years he's been paying on this policy. The policy has been paid up a while ago, right? So this is how powerful this is. And this is kind of like the thing people miss, and especially why I talk about with the whole savings account thing. When he passed and we paid for the funeral and stuff, and this is, people don't like to have this conversation. They really need to, especially in the Black community. The policy had accrued so much interest over that time, and this is tax-free, by the way, because mind you, life insurance is completely tax-free. So I've had people
Ding, ding, ding.
say crazy stuff to me. Like, I don't care if you make $40,000 a year or you make $250,000 a year. There's nothing better than receiving a large amount of money that you do not have to pay taxes on, okay? It had accrued something like $14,000, $16,000 in interest, okay? Completely tax-free that my grandmother and his wife ended up splitting, right? So I find it funny because I'll meet with people who are very high income earners. I've met with people who the combined household income is $1 million between the husband and wife, right? And those, we'll go through, the whole spill, and I'll break stuff down to them and I'll say, hey, I think we're good. We got a bunch of money saved in the bank. She makes a lot of money. If If something happens to me, she could afford the house by herself. She'll be all right. And I'm sitting there and I'm just like, but why would you use your own money? Like if you could use somebody else's money, why? Okay, you have
Well,
50.
it's your money, but why would you not leverage it better?
That's what I'm saying. Like if you have 50,000 in your savings account right now, why would I want to burn up my whole 50,000 and I could just have the insurance carrier for pennies on the dollar kick out that same money and it'd be tax free. It just the math just never the math just doesn't math to
It
me.
doesn't matter.
So and when I explain it to people, I'm like, what you're saying, if you're that well off, then what's $100 for an insurance policy?
Right.
It doesn't make sense. So
And where are you keeping it? You're keeping it in the bank in a savings account
that's
that's
not growing any
barely
interest,
making any interest, right?
making
When
no interest. So it's and I was thinking about this before we started. The disparities between different ethnic groups. Like I meet with clients of all ages, all races. The black community specifically, it's a totally different conversation on life insurance from, let's say, when I meet with a white client. A white client, it's very much like they could both be making $60,000 a year. And the white client is like, why can't I get more? And the black client is like, why does it cost so much? It's never, how can I get more to make sure the family's protected and this is paid and the funeral and whatever else? They're so focused on the cost. And this client is like, how can I get more than that? Can I get another policy with a different carrier so that we can make up the difference? And so we have to change like our whole stigmatism and how we even view life insurance, and that's easily 60-70% of the clients I meet with. The area we live in, the DMV. I meet with a lot of clients in DC, PG County. PG County is one of the richest counties in the US. These people are all like 100,000, 150,000, 200,000 and up households. And we're talking about spending $50, $100, $150. It doesn't
But
make
like you
sense.
said, I think it just has to do with it's not even stigmatism, it's the education. It's like if I'm from Jamaica originally, coming to this country, there's nobody to teach me about credit. My mom came with me. You know what I mean? I've had to learn the importance of credit and leveraging that and certain things, and even now learning about life insurance, et cetera, et cetera. If your parents and your parents' parents never taught you that, now you're learning that. And so I think that's why this discussion is important, to really simplify it and help explain it and help people understand why this is so cool, actually, instead of putting it in the bank or putting it under a mattress, like how you can really leverage this to do things. And I think that's what's been missing.
I mean, the big thing is there's a lot of living benefits with life insurance. So people have the assumption that it's only somebody's going to get some money when I die.
Right.
That's a lot of people's presumption and why they have a negative outlook on it. And nowadays, the majority of the benefits are actually living benefits. Carriers have invested a lot to the riders that would get added to these policies that people had to pay an extra $10, $15, $20 for now come free on the policy. They cover you for chronic illness, critical illness, terminal illness. So people who are getting cancer, HIV, AIDS, all this different stuff, the policy is going to cover you. I've insured clients who I'm currently meeting with them and they literally have stage 4 cancer. They literally have AIDS today and they still can get coverage. And these are the people that are like the highest risk that when they die, no one's going to be able to pay for their funeral. They're not in contact with a lot of family. They don't have kids, parents long gone, whatever the situation is. They don't have a lot of money in savings. So, as you're learning about this stuff, we have to have that conversation because like my grandparents never were going to bring it up. I took over my grandparents' house. They live in Landover. If I didn't come and have a conversation with them and say, hey, what are you guys going to do with this house when you guys are gone? Because, my grandmother's son is now gone. She can't leave it to him. And my brother and sister are off doing their own thing in different parts of the country. So if I didn't bring it up, nobody was going to bring it up, right? So somebody has to be the first one to say, I'm going to have a hard conversation with my parents, grandparents, whoever it is, to make sure stuff is in order. Because what happens every day is what? We see it all the time on Facebook. Somebody starting to GoFundMe, somebody looking for donations, charity, whatever, because stuff can't get handled because nobody wanted to bring up a thing that really could have been like a 10-20 minute conversation.
Right.
It would have been done with.
They consider it morbid, but it's not morbid. It's actually like a necessity.
Yeah, it's part of
Life,
life.
yeah.
Yeah.
It's part of life. So,
Now, what about, not to cut you off, David, but what about insurance for your children? Can you talk a little bit about like the importance of getting insurance for your children?
yeah, so I'm a huge advocate on parents getting their children insured. I think it's a hard conversation parents don't even want to think about, especially like I've had people insure their newborns and they're like, I don't want to think about my baby dying. And it's not about them dying. The way you have to look at it is, okay, the best case, the more likely scenarios, they're gonna live. They're gonna have a long life. They're gonna
Right.
outlive you, right?
Mhm.
And if you get them a policy now, like I can put children on a whole life policy for $20. And that policy will stay $20 for the rest of their life.
Shut the front door.
Because it's a whole life policy. It's level. It doesn't change. So it's like, why would you not want to set them up for success? You know, all our parents waited till they were 50, 60, 70 years old to get insurance. They're pissed. They're paying $100, $150 for a little 20,000, 40,000 in coverage because you waited to the end of your life to get coverage. You could get your kids coverage now. You could get them like a $50,000 policy. It's not you're trying to kill your kids. You know, hopefully your kids live a long life. You transfer the policy ownership to them. It'll be accruing interest all that time. They can use it for stuff like paying for college, buying their first car, you know, whatever it is. And they continue living their life while it's growing interest in the background. And they never have to worry about getting some crazy expensive policy when they're an adult because their parents already handled it.
So this was my consideration because I have a policy like this. And I remember thinking, couldn't I just be putting money in his savings account?
You could, but now you know that the
It's the
interest in the savings
It's the
doesn't.
same,
It's
yeah.
basura.
Same. I don't know what she said, but that,
Trash.
that, that. Yeah, I mean,
So
it's
the
not.
interest rate is better.
Yeah, the interest is going to be better, right? So, like, even on like a basic children's whole life policy, they're still going to get an average of like 4% a year. So think about like when you get that for a young child, and then they turn 18, how much money is going to be there? That compounded interest every year over time,
Right.
right?
And they can take it out and use it.
And you can use the cash
Absolutely.
value.
Absolutely.
But when you
So
do that, you're borrowing
you're borrowing your own money.
your own money.
Your
Before
own
the
money.
term is over, though. But once, I mean, doesn't it fully fund at some point? Like if you have a 30-year.
Not for a child, right? Because for a child, it was already so inexpensive to insure them
Mm-hmm.
that it's not going to be fully funded. The carriers are very smart about how they structure all policies, right? They want to get money from you as long as possible. So unless you choose to put a bunch of money in and overfund it, the premium payment is set up in a way for you to pay for 20, 30, 40, 50 years. So even if I put it on a 1-year-old, it's still set up in a way for that 1-year-old to have payments till they're 79 years old, right? Which is why it's only like $18 a month, $15 a month, whatever it is. And if that's all they paid for the next 60, 70 years, it might be paid up by the time they hit like 65, 70, something like that, right? It's
So wait, so if you get like let's say you get a $200,000 policy, a whole life policy on your child, and you pay out the 200,000 over the 30-year period,
you never would pay that 200,000 out.
you wouldn't.
It's never set up that way.
You
And
said
that's and people
they
have
short it like you'd have to put extra money
Exactly.
into it.
the premium is never calculated in a way where you would end up paying the same dollar amount as what the death benefit is. It's never going to happen. The only way that happens is if you overfund it. And if you choose to, and you can't even overfund it unless it's like a whole life IUL, because you can't do that with term and some of these other policies, right? So let's say it's an IUL, you have to actually overfund it for that to happen. You'll never even get close to what that number is. If I met with somebody that's like 65, 70 years old, now let's say I'm just making up numbers. Let's say they got to pay like $150 for a $20,000 policy. And I've had people say this to me. They'll say, oh, I could just keep that $150 in the bank. That money will probably be there after a couple years. And I'll be like, okay, let's get on our calculators. Let's do some math. What's 150 times 12? Multiply that times like 10 years, whatever it is. You're not going to get to, it's going to be a very extended period of time before it hits that number. And it only gets close to that number for older people. So for younger people, you're not even going to get close to that number, anywhere close, because somebody 20 to 45, 50 years old, we're paying very little for coverage unless we're very sick. If you're a much older person, it's different. When you're 70, 75, 80 years old, you have to pay a lot for coverage because you're closest to the end of your life.
So then what's the point of getting a $200,000 policy if you never get to benefit the $200,000?
Well, you do because
Unless you die or while you're living.
so most IULs, and like this is even with your kids, right? If you look at, they have this thing that comes with the policies. It's like an accumulation table, and it's broken down for every birthday that you'll hit for the rest of your life, right?
Mhm.
If you look at that table, and this is why policies are like 100 pages long, and you skip all the way to like the 65, 70, 80th birthday, and this is how I structure all my IULs now, you'll see the death benefit has started increasing. And you'll also see that the cash value starts jumping significantly at a certain birthday. So it depends on how long the person has been paying on the coverage. So typically, once you've been paying on it for about 20 years, cash value starts to jump very significantly. And this is why it's really beneficial for kids and young people, because like you get it on a 1-year-old, that's going to start hitting those numbers when they're 20 already, because they've already been paying on it for a while, right? So when this person, let's say like in Lincoln's case or something, right? When he's a senior, there may be so much cash value there that the cash value will start to supersede the death benefit, and he could just cash out the policy. So let's say it's 200,000, but because he's been paying on it for 40, 50 years, now it's 280,000 in cash value, in interest, right? You just cash it out and call it a day and just collect that money. Now he's going to pay taxes on that money because now he's collecting it as income. It's not tax free anymore because it's not going to a beneficiary, but he could just collect that money. Or you could just say, I'm gonna still leave it to, family members, whoever, right? But that is typically what will happen in a whole life IUL situation. It will get to a point where and that's what just happened with my uncle's case, right? My uncle's policy was a $50,000 policy, but it accrued so much interest that what they paid out was over 60,000. It was like 64, 65,000 and some change because it accrued so much interest. So that's what we actually collected. So instead of waiting for the person to die, they could just say, hey, I want that money for myself.
So when you collected that, did you pay taxes on it?
No, because we're beneficiaries,
Okay.
right? Now, if you were the insured, collecting it for yourself, you would. Yeah. So but again, this is not like a get rich quick, try and have a bunch of money in 2-3 years type of thing. This is for people who want a long-term vehicle that's there in the background that makes sure that if something happens, they're insured, they're covered. Because if you get insured on a $200,000 policy and you die tomorrow, the carrier has to pay that coverage out. This is not like people always compare it to like health insurance and car insurance and stuff. It's a totally different thing.
Yeah.
You could pay for health insurance every single month, and something happened, and the health insurance carrier says we're not paying for that, or you're not covered for that, or we're not paying for that surgery. You've already met whatever your deductible, your number, all this other stuff, right? Life insurance is typically a harder process to get because they make sure beforehand that you're good. They've assessed the risk already because they know they have to cut the check. They absolutely have to cut that check no matter what. And the only way they're not cutting that check is if you lied on your application. And somehow it's slipped under the radar because they have ways of seeing if you lied or not. But I've had people where that's happened and their policy gets rescinded. They got coverage 1 year, they died the next year. There's 2-year contestability on every policy no matter what. So no matter what, if it's IUL, term, whole life, whatever, they all have 2-year contestability.
Oh.
Lied about what
I
on
didn't
their
know that.
application? Like, what do you
It
mean?
could be anything. So like we had a client one time. It wasn't my client, it was another agent. She actually had AIDS. And what the carriers do, so we don't do medical exams anymore. That's a thing of the past. They don't come and take your blood and urine and all that stuff anymore. The only thing they're checking is your medication history, right? So if they can't see a medication from a doctor, pharmacy, wherever that would decline you, then you're going to get approved. So this lady had been going to a doctor out of the country. So nothing's going to show up in the system.
Right.
You haven't been seeing a doctor in America for years. She was going all the way to Africa to get her prescriptions for her AIDS and then coming back into the country
How did they find out?
because she's dry snitched on herself. came up in conversation.
Dry snitch.
Definitely dry snitched.
Not moist snitch.
She randomly let it slip during conversation. And so
Oh gosh.
and the application had already been submitted. So it was already a done deal. It was going to get approved because they do a pre-approval as soon as we submit it. And unfortunately, I mean, I'm not about to lose my license. That person wasn't going to lose their license. So when we hear stuff like that, we have to report it to the carrier because it falls on us, right? So it's like if you knowingly knew something about the client,
Yeah.
So then you re-snitched on her.
well, it wasn't my client. I didn't do anything. It was somebody else's client.
There's a lot of snitching going on.
It wasn't my client, but yeah. So I mean, she got declined. So when that stuff gets reported, it gets reported to every insurance carrier because they all use a similar system. They have what's like a medical credit report that's just like how the banks and everybody else uses. So if you went to like a Mutual of Omaha and got coverage and got declined, and then you went to
Y'all already know.
America, they're going to know. They'll see that something happened in Mutual of Omaha. They're going to say, hey, what happened over there? Why they declined you? And they're going to slow up the process or they're going to stop it completely. So it's very little game playing, but every now and then somebody slips under the radar and then they'll send that letter out after you die to your family and say, hey, we found this out. You weren't honest in your application. So your policy has been rescinded. We're refunding all your premium payments, but we will not be paying that death benefit.
Oh, so they give you back payments like up until, but they're not gonna give you
Right. They're not going to pay the death
so if you
benefit.
died before hitting the number.
It's only within the first 2 years. So after that, you're kind of in the clear. I'm not trying to promote people lying or anything. Don't lie and hopefully slide through 2 years, but it's only for the first 2 years. So once that 2 years passes, they can't contest anything. You die, they got to pay. But if by chance you die because it's highly unlikely usually somebody gets approved for that type of coverage and then you die, right? And if you do, it's something like, car accident,
Oh, I thought he meant
something
like
unfortunate.
when they're about to pay it out, they still have 2 years to like investigate
No,
or
no, no,
see.
no, no,
Okay,
no.
that's what I
No,
was confused
2 years,
about.
2 years from the time that you got it and it went effective is the contestability period. So once that 2 years passes, whatever happens, they have to pay out.
And I know, like, I mean, obviously we're not discussing trusts here and stuff like that, but there's even further things. Like if you have life insurance, if you have insurance, you can put it within a trust and have that whole thing be a bank for your, your family, so there's like just so many things, like I said, that we don't know how to leverage. And I just really want us to,
It's a lot of caveats to it. So
Yeah.
I'm not a lawyer. I don't give legal advice. But I do tell every client I meet with to get a living will because even if you have life insurance is a legal document that circumvents court. It does not circumvent all the other stuff that can go to probate court, like properties, like any assets, money that's in the bank, stuff like that. So when you don't have a living will, that's the stuff people are going to go fight over in probate court because you didn't have a will in place. So a lot of
Evelyn
people
knows all about that.
a lot of people don't understand that part because they may not have lived through it. So they assume like, oh, I got a car, I'm leaving it to my son. I got a house, whatever, right? So like perfect example, my uncle also, him and his girl were together for 20 years, never got married. Even his medical stuff, all the times he had to go to the hospital, they could not discuss it with her because she's not his legal wife. They always called my grandmother, right? So, you have all these people that's in like these situationships and long-term relationships. And I've had plenty of people that are like in a 10-year relationship with somebody, get life insurance, put their girlfriend on there. And I'm like, she's not your wife. So all this other stuff you got going on, all these investment properties y'all got, all that's going into the court system when you pass away if you don't have a will.
through probate.
It's all going to the probate courts. You gotta get a will done, absolutely.
So I just want to stop you for a second because you're talking about a will, and are we talking about trusts
Yep,
too?
absolutely. Trust is super
because
important.
For a lot of jurisdictions, if you have a will, you still have to go through probate. Like a will is a great way to designate what you want to happen with your property, with your assets, which is particularly important if you want something to happen that would not happen if you died intestate, right? So if you died without a will, there are statutory requirements in every jurisdiction of like, if you die without a will intestate, then this is what automatically happens.
Like how you were saying,
so like
go
the money
to
goes to your
mom
spouse
instead of the.
Exactly. So like there are certain situations where it's especially important. Let's say you want to disinherit a child, I've certainly had to review like some really
Wow, that happens.
Wild.
No, I mean,
Sheesh.
when you get the email that's like, do not share this document with anybody, that's when it's like, oh wow, what is this? What's
Mm,
about to happen in here? Like, what's in this document? And oddly enough, a lot of the times that trust or that will is actually saying the same thing that would have happened without a will. So I'm always like kind of
really?
surprised by
You're
that,
like,
that
what?
it's
Okay.
not as important if, if you're married, there's a legal construct that actually spells out what's supposed to happen with your assets because of
The
the
legal
marriage.
marriage, yeah.
When you have families that are a little more unorthodox, if you're not married, if you have like a Brady Bunch family, like kids from your, a previous marriage, or extended family that you want to provide for or something, or if there are specifically like children or something that you don't want to inherit certain things, that's when it becomes even more important to have a will. But the trust is the one that avoids probate.
Yeah.
The trust is actually like a living entity. It's almost like a company or something. And so the trust doesn't die when you die. And so when you put assets, when you fund your trust with your house or with your life insurance policy, your trust just keeps living on like a person. And
Mm.
that agreement spells out what is supposed to happen with your assets.
So, question, Evelyn. You put this house in a trust for me. So
Yeah.
I could just continuously add to that specific trust, even though it has the house in it already?
You could. So we could amend your trust agreement to change the beneficiaries of that trust.
But could I put other assets under that same trust as
Mhm.
well?
You could. Yeah.
This is
Yeah.
why I don't give legal advice. I send them to
the
someone like
lawyer.
her to give legal advice. I send them, go talk to someone.
Well, David, you've given us some really great advice today, though. Thank you so much for
Thank
It's
you.
coming
very
Thank you for
on.
having me.
sexy advice.
It was super sexy. How
Thanks for
can
having me.
people get in touch with you after this if they want to reach out to you?
Instagram is the Hill Agency LLC. Email is the Hill Agency Corp at gmail.com. Yeah.
And you
And
will sit down with them and you will custom tailor
everything.
everything
Yeah. So I
to
meet all
suit
my
them.
clients face to face
Uh-huh.
unless they, request virtual.
Right. If they're not in the same state as you, you could still.
I'm actually licensed in the entire DMV and Florida and Pennsylvania. So
Okay.
if you're not in those states,
So
I
if
will,
you're
I
in
will
New
get
York,
licensed.
if you're in New York,
That's the only state we don't deal with. New York
Okay.
has very specific guidelines around
sorry,
life
my
insurance.
New
Yeah,
Yorkers,
sorry.
I'm so
Maybe
sorry.
one day, maybe one day. Every other state though,
Mhm.
yeah, it's wide open. But yeah, I will work with you personally. Also hiring agents. I have a couple agents that work under me. So anybody's interested in getting an insurance or wants to find out more about life insurance, yeah, absolutely hit me up.
Awesome.
Yeah,
Awesome.
I
Well,
appreciate
thank you
guys.
so much.
I was in good company.
That's it for Heroin Chic, guys. Thank you for joining us. Thank you, David, and to my co-host.
Till next time.
Bye.
We'll see you soon.